This is a Silicon Valley real estate market analytics update for July 27th, 2024. And then we will finish off with the Greater Bay Area, which includes 5 regions, 13 counties. This is good for home buyers, sellers, people curious about the real estate market. It's focused on Silicon Valley. We'll get back to this on how to participate later. Here is the first summary slide. And what we're doing here is we're looking at the key indicators. Inventory a quarter ago, 14 weeks ago, was down at 82% of normal. Now it's at 80% of normal. So, 2.5% shift, basically no shift, or 3% shift, no real change. The gray line is where the market typically is. So you can see it's following the typical pattern. The red line is the least amount of inventory you'd expect, and the blue line is the most inventory you'd expect. It's more or less following the typical patterns with roughly 20% less inventory than you expect. Offers, on the other hand, started off below the least you'd expect because it's below the thin blue line, and it's now right on the thin blue line. So it went from basically 71% to 81%. So we've picked up 10% of the normal number of offers, which is a good thing. We've been missing transactions, and, that means fewer title companies, fewer loans, fewer home inspections, fewer termite inspections, the whole 9 yards. But we've picked up 10%. We're still missing 20% of the marketplace, but we've picked up. Because we've picked up offers and inventory is still low, the DUI is up now at 105%. So it's a little bit slower than normal, because here, the higher the number, the slower the marketplace is. So you're 5% up over normal. But again, that's up from 13% slower than normal. So it's a slight improvement in that because of the improvement in the number of offers. It's sort of interesting, at the same time the market is accelerating as measured by the days on sold inventory. And this is the speed that a buyer and seller should sense when they're making offers and everything. The time to sell 75% of the homes has actually increased. We were at 85% of normal at 14 days. We're now at 20 days, so an increase of 6 days. But more significantly is we've picked up almost 13% of the speed. So it's taking, 97.6%, I'll call that normal. I mean, if 100% is normal, you're darn close. And you can see that you were pretty close to the red line. You were quite a bit below the gray line. Now you're basically right at the gray line. You can hardly see the gray line peaking above the purple line. The purple line, of course, is the data line. And then if we move down to seller ask price reductions, you can see that, normally they're a third of 1%. Now at this time of the year, they're almost a full percent. And so, that you can clearly see sellers are taking a bigger price reduction. But then if you look at the percent of normal, it's 16% more price reductions than normal. And now it's only 19% more. So there's been basically no change in the amount of price reductions compared to normal. But what's normal is this fairly significant increase in price reductions. We've gone from a third to, almost a full percent. So you've tripled the amount of price reductions that sellers are taking. But that's what we normally do at this time of the year, since the percent of normal has not changed. Also interesting is overbidding has come down from 9.6% to 6.4%, but that was almost 3% above normal, and now you're 0.2% below normal. So you're essentially at normal, down from 3%. But if you're only normally 6.4% above normal, 3% above that at 9.4%, essentially, or 9.3, down to 6.2, because you're now 0.2% below, is actually fairly significant. So that's the quick summary. Now we'll get into the individual things. We'll start off with looking at Silicon Valley as a whole, and we're looking at inventory here in the purple, and you can see that inventory is basically below where you'd expect. It is at 80%. It's up from where we apparently were 13 weeks ago, but we are down from where we were the last several weeks. We basically got up to 90% of inventory, and now we're basically back down into 80%. So we've lost 10% of the marketplace recently. What am I saying here? Because, on the quarterly slide, quarterly, you're coming back here. And so you're basically increased from, somewhere around 70% up to 80%. But from 4 weeks ago, you've gone from 90% to 80%. So that's how much the market does fluctuate at times. And then if we look at offers have come up recently in the couple weeks, and we're up from where we were a quarter ago. So you can see we're down here, and now we're higher than we were a quarter ago. And then the speed of the marketplace is faster because it's lower now than it was about a quarter ago. And I'm only estimating what they were. So really on this graph, what you're looking for is recent trends. So the recent trends is inventory is down, offers were down, but turned around and up a little bit. So call offers maybe flat, causing your DUI to be coming down as the inventory comes down. And DUI is still above 100%. So the market is a little bit slower, not much, 5% slower than it typically is for this time of the year. Now we're going to just focus on one thing, days on market. This is a distribution of all the stuff. So your 10% of the sellers are on the market for basically somewhere around 5 days reading it. 50% of the sellers, because you're going to the purple line, are on the market for 10 days. 75% of the sellers have sold after about 24 days. 85% of the sellers have sold after 40 days. And 90% of the sellers have sold up here at something like 47 days. So that's a distribution of how long it's taking the number of sellers to sell. The red dotted line here down at the bottom is the fastest marketplace we've had, or the best marketplace we've had. And that was Valentine's Day of 2022. The worst we ever had was December 27th of 2022. So in the same year, we had the best and the worst weeks. And in between, we just stepped through. Now, the current week is the purple, but we're starting off a year ago, which is the blue dotted dashed line down here. And with the blue being below the purple, the market is slower right now this year than it was a year ago. Because again, the purple, the current, is above the blues. And as you go up, you get a slower marketplace. So you're slower. And we'll step through. We're going to start off here a year ago on the blue dotted dashed line. And then you can see the bold is right there. And I was having a hard time. There it is up here. Now it's up here. So it's about the slowest. Now it's starting to improve. Now you're way down here. Now that's the peak of the marketplace of 3 months ago, 12 weeks ago. And now you're sort of at a plateau. And now you're going to slowly start slowing down. And the dashed lines are in between, and the solid lines are the most recent. So you can see that we've been moving slower and slower. And, that's sort of the typical marketplace we are doing. So sellers that came on the market 3 and 4 months ago were selling faster than the sell, because they were down here at the best that we were for this year. And we're now up here, which is significantly slower. So sellers that were on the market 3 or 4 months ago were selling much quicker than the sellers that are on the market right now. And what am I saying much quicker? Well, 3 months ago, 75% of the sellers were selling in about 12 days, it looks like, and now they're taking 26 days to sell. So they've basically more than doubled their time to sell. Now we're looking at the ask price reductions. And here, because so many sellers don't do any ask price reductions at all, I only go from 2.5%, and this would be the 2.5% of the sellers that are taking the biggest price reduction, to 17.5%. So I'm ignoring, or 82.5% of the marketplace, because they're not doing any price reductions, and plotting data at 0 and trying to understand what the market's doing based on data at 0 doesn't help you at all. The purple dotted dashed line here is where we are right now, but we're starting off with the blue dotted dashed line of a year ago. A year ago was a hotter marketplace than we are now, and we'll step through and watch. So there you are. Now you improve the cool down. So this is the end of the year slowdown, which is what we're going to going into. And now here's the spring run up, way up to there. Right there's the peak 3 months ago, and now you started to slow down. So 12 weeks ago, we were already slowing down, and we're continuing to slow down. The amount of slowdown is, in my opinion, slowing down. You can see the solid lines are sort of closer together. There's where we were 4 weeks ago. Then we improved, and then 2 weeks ago, we were back down. And, the last 2 weeks are not that dissimilar to where we were 3 weeks ago, that kind of thing. The price reductions, we're taking more price reductions than we were a year ago, but we're also not way out of line. We're pretty close over here. We have a little bit more separation up here. So basically what it's saying is a larger number of sellers are taking price reductions. Now we're looking at overbiddings. This is a lagging indicator. And last week, if I remember correctly, the purple dotted dashed line representing this week was right on top of the blue. This week, the purple is a little bit lower, which is a little bit slower, which is what I was expecting. The reason this is a lagging indicator is we need to wait 3 to 6 weeks to get the sale price to know if the sale price is higher or lower than the seller's asking price. So again, stepping through, you can see that we, sort of were plateauing, and now we're going to go into the end of the year slowdown. And there's 6 months ago. So that was the bottom of the marketplace. And here's your spring run up. And frankly, right about there, about 12 weeks ago was also the peak, but so 11 weeks ago was right there. There isn't as much change. And, it's basically 12 to 10 weeks ago was the peak on this indicator. And now you can see it's dropping down, and it continues to drop down, and it's just slowly moving down. And I think that's the direction we're going to continue to go. Now, what's interesting is why the first two leading indicators, sort of indicated the peak of the marketplace was 13 weeks ago, 12 weeks ago. And this indicated the peak of the market was maybe 10 weeks ago, something like that, 12 to 8 weeks ago. Is one, overbidders tend to be aggressive offers, so they tend to close quickly. And so those are the few escrows that are closing in 1 week, 2 weeks, 3 weeks. So their time delay to report on overbidding isn't as long as the typical buyer that's going out and getting a loan that needs 3 and 4 weeks to get that loan approved and funded and closed. So the downward trajectory, when you're looking at going from a competitive marketplace to a slow marketplace, appears to be significantly less than the 3 to 6 weeks I would expect, more like 1 to 2 to 3 weeks. And again, I think that's just because the people that are doing the biggest overbidding are the same transactions that are coming in and closing. I don't have any data to support that. Now what we're doing is looking at each component. Again, Silicon Valley as a whole. The gray line here that's thin is where we expect the market to be. The blue line up here is the slowest you'd expect the market to be, or the most inventory. And the red line is the hottest marketplace. And in the case of inventory, that would be the least amount of inventory. So you can see we're, roughly midway between the least amount of inventory you'd expect and the typical inventory you'd expect. So there's a shortage of inventory, but it's sort of in the realm of where you would expect the market to be. This basically is your 10 percentile marketplace. This is your 50 percentile. And, you can't just go your midway and say that's going to be your 30 percentile, halfway between 10 and 50. You can't do that, but that's sort of the concept. What you're really looking for is the shape of the purple line compared to the shape of the gray line. Here you can see that inventory is decreasing compared to normal. So it's decreasing faster than it typically is, or we're losing, inventory is decreasing more compared to the typical. This is taking that gray line and stretching it out, and then seeing if the purple line is getting closer or further away. In this case, it's getting further away in the direction of less inventory. Here's your same thing with the number of offers. Now pay attention right here. The number of offers is actually below the 10 percentile. So we're selling less homes than you'd expect. So out of the last 10 years, only 1 year has had this kind of level of inventory. So we're below the 10 percentile. The median's way up here. This is the typical. This is where this is exactly the median for the past 10 years. This is the 10 percentile for the past 10 years. So it's the lack of buyers. It's really talking. And if you look at the previous slide, the inventory was sort of, in between the gray and the red because of lack of inventory, which means that the offers are not being restricted by the lack of inventory, because the lack of inventory is less severe than the lack of offers. And here you can see that we've actually improved this last week compared to where we typically are, but we're definitely below 80% of the level of inventory or level of offers you'd expect. Now we're moving on to days of unsold inventory. And again, days of unsold inventory is between the gray, the typical marketplace, and the blue, the slow marketplace. And, it fluctuated fairly significantly for July 4th. We talked about that before. With July 4th being sort of in the middle of the week, a lot of people took off the whole week and made the July 4th a larger holiday, which negatively impacts real estate. So that's why there was a bigger disruption this year than there typically is. You can see every year in all my measures that there's a disruption for the holiday. And that's true. Holidays negatively impact real estate, except for Valentine's Day and Mother's Day, which have a slight positive impact. And the reason for that's quite simple. Real estate's an optional event. where you have social obligations, you take a week off from looking for a house, participate in those social obligations, and then resume your house hunting. And that's exactly what we see in the marketplace. So days on unsold inventory is a little bit higher than you'd expect, a little bit cooler, and basically the number is somewhere around 42 days. That means we'd sell out the entire inventory, existing inventory, in just a little over a month. Here you can see that we've been improving compared to normal, so we're getting closer to that gray line. Now we're looking at the 75th percentile. So marketing time, even though days on market was higher and slower than normal, marketing time is right on the gray line. So this is exactly where you'd expect the market to be. And that's basically saying that you're selling, 3/4 of your sellers are selling in 20 days. And that's a pretty fast marketplace. And this is for all of Silicon Valley. So that would be Santa Clara County, San Mateo County, and Alameda County in a blender. And here you can see you're basically just a little bit faster than normal, but you're bouncing from week to week, which you don't like to see in metrics, but real estate is pretty cyclical, and it's hard to get measures that are real smooth, which is one of the reasons I go back and look at things for a 5-week moving period. We want it sort of a month at a time, but it's the 5 weeks because real estate has a heavy weekly cycle. Here's the seller's ask price reductions. So you can see we were getting pretty close to the blue line. We've taken an abrupt turn, and that sort of surprised me to see the reduction in price reductions. So we're having fewer price reductions now than we would have just a week ago. So you can see that we're moving back towards the gray line. You know, why, who knows? And it could be a 1-week fluctuation. And again, you can see there's a fair amount of bounce in this metric. So here you can see the improvement from 20% more price reductions than normal down towards maybe 15% more price reductions. So an improvement, but still more price reductions than you'd expect. Here's the seller's ask price reductions. So here's your zero line. And even in a hot marketplace, you're basically typically taking some sort of a price reduction. And so you have to keep that in mind. The gray is where you'd expect the market to be, and that's somewhere around 0.8% of a price reduction. And here you're down at 0.9% per price reduction. So you're taking 1/10% more. But when you look at it on a percentage basis, that'd be about 12% more. You know, 1/10% is 12% of 0.8%. So if your base is 0.8 and you're taking 1% more, that's a 12% larger number of sellers taking price reductions. And that's not the number of sellers taking price reductions. That's the magnitude of the sellers that are taking the price reductions. So sellers that are taking that price reduction, instead of taking a 10% price reduction, could be taking a 11.2% price reduction to get that 12% price reduction increase. Here we have the same concept where we pull the line out, and here I pulled the blue, the red, the pink, the hot marketplace below a zero price reduction to indicate that even in a hot marketplace, sellers are taking some price reductions. So here we are in a cool marketplace with taking more price reductions than you'd expect. Where you'd expect the line to be is, you know, somewhere in this window of typical marketplace. Here's the seller frequency. More sellers are taking price reductions, but not very much. It's the vertical separation. So you'd expect to be down here, so around 15%, and now you're up here somewhere around 16% of the sellers are taking price reductions. So 1% larger number of sellers are taking price reductions. Clearly not a large number, but again, this is why I only go to 17.5%, is we were rarely over 17.5%, and you want to see movement. If I had 87% of my changes being zero, you really don't see any change. Here's compared to normal, and you can see that we've been sort of in a long-term slow upturn, slowing, increasing number of price reductions, but with some bounce in between for individual weeks. Here's the average overbid. So we're flipping from sellers to buyers, and there's a time lag in here. And as I said earlier this week, the time lag for the most aggressive offers may only be the 1 week that they come in because they were cash and they want to get their offer accepted. But the typical close of escrow is more like 3 to 6 weeks. And so this is a lagging indicator, but right now you're right on top of the typical overbidding, and that's somewhere right around 4% overbid. So you have about 4%, and that's basically right where you'd expect the market to be. In a hot marketplace, you come straight up, and it's hard to come straight up. You'd be up here somewhere around 6.5% overbid, and in a cold marketplace, you'd be down here somewhere around 1% overbidding. So even in a cool marketplace, there is overbidding. And you can see that we're actually a little bit below the gray line according to this plot. And you can see how much the overbidding has come down. And this is where, buyers have to readjust and even sellers have to readjust. This kind of drop in the amount of overbidding in only a few weeks is a pretty rapid slowdown. Here's the frequency of overbidding. So overbidding is becoming more closer to typical. It's still a little higher, which means more buyers than normal are going above the seller's asking price, but it's getting closer to normal. Here is the thing, and you can see you're very close. You can't see it below yet, but it almost looks like it, but that's the width of the data line. So I'll take my previous plot and say that we're slightly above 100%. Here's the long-term pricing. The blue sloped line is sort of my rough draft of the long-term appreciation. And there's two key takeaways. One is the price decrease at the end of the year, because the vertical dark line is every year, and you can see how consistent that is. And even in very hot years like 2021, it basically plateaued. And in 2020, you had a little bit of a U, but every other year coming back, you had a fairly noticeable V of prices in the downward trend. I would also contend that you've got this U-shaped overbidding that happens every year. So there you're overbid, there's sort of your overbid. It's sort of hard to see it in 2020, which was pandemic. Here's the round overshoot, here's the round overshoot, the round overshoot. So what does that say? It says prices go up and they overshoot the long-term appreciation. And then at the end of the year, so starting now and towards the more you wait till the end of the year, the more you're going to be below that appreciation, which means that more likely than not, we're going to see an increase next year in the first quarter. Here's your estimated payments. And on this, I just want to again point out that I'm using the National Federal Reserve Bank average for loan rate, which is 6.77 maybe this week, or 6.79, something like that. And you need to keep in mind in California and Silicon Valley, most of the buyers are using jumbo loans. So I happened to look, I think it was at Wells Fargo, was at 6.25 for jumbo loans for a 30-year fixed mortgage. So if you're getting a jumbo loan, you can get quite a bit lower interest rate. And that's inverted from when I started in the real estate in the 80s. People that were doing jumbo loans paid a premium, and now people doing jumbo loans are getting a discount. Here now is looking at the 3 counties, and we're starting off here in San Mateo County in the orange. We have Santa Clara County in the blue, and Alameda County with the most active listings in the gray. And it's interesting, Alameda County and Santa Clara are normally fairly close together, with Alameda County being on top. So they're roughly in the same ratio, and they're in the right order and roughly the same ratio. I would say that Santa Clara is missing some inventory relative to Alameda. San Mateo County is basically right within the realm of normal. I mean, you come back and look at their inventory really is in line. Now, if you look at the offers accepted in San Mateo County are clearly dropped below. And here, Santa Clara County has more offers than Alameda County. So Alameda County has more inventory and less offers, which means it's a slower marketplace than Santa Clara that had fewer active listings and more offers. So Santa Clara County is a faster paced county than Alameda. And you can see that right here. Santa Clara County is the fastest with the lowest number of days unsold inventory, which is somewhere right around 35. Then you have San Mateo County at some number right around 44 point something. And Alameda County is the slowest county at 48%, 48 days. And I think we're going to see later that Alameda County has some of the highest overbidding, which you would not expect with one of the slowest marketplaces. So here's marketing time. This is just so people that don't like statisticians playing around with numbers. Santa Clara County has the fastest market time with 22 days for 3/4 of the sellers to sell. And then San Mateo County is second, it looks like at 28 days. And Alameda County is third at about 29 days to sell 75% of their market. So again, Alameda is the slowest. Now we're looking at price reductions. Alameda County has the most price reductions, followed by San Mateo County and then Santa Clara. And you got to keep in mind, these are very small numbers, and that's just because this is an average. So here we're taking into consideration that 82% of the sellers don't take a price reduction. Here's the frequency. Alameda County is doing the most price reductions. Santa Clara County is doing more price reductions than San Mateo. That's a reversal. So that's noteworthy. It's not significantly different. And now you're getting into overbidding. So here we have the most overbidding in Alameda County, and that's exactly what I said earlier. So Alameda County has the highest amount of overbidding, but it's the slowest marketplace. And that just doesn't make logical sense, but that's what the market's doing. That's why it's important to look at more data to get a feel for what the market's doing. So even though it's slower and sellers are doing more price reductions in Alameda County, it's got the most overbidding going on. So you can't go out there and say, hey, it's a slower marketplace, so I don't have to overbid as much. And then Santa Clara County actually has the least by a little bit, with San Mateo County just beating it out by ever so slightly. It looks like it's basically, Santa Clara County is about a 5.5% above normal, 5.5%, and San Mateo County is 5.75% above the seller's asking price. Overbidding. Here, Santa Clara County and Alameda County look like they're dead tie. So that is interesting. So the overbidding in Alameda County, to have a higher magnitude, has to be the magnitude of those buyers are buying overbidding more than the number. Both are at 70%, and San Mateo County is down at about 62% overbids. Here's the long-term appreciation since the last 9 months of 2015. You can see Santa Clara County has had the most appreciation. The rate of appreciation in all those areas is coming down, which is interesting. Here's the long-term pricing. So you can see that San Mateo County is the highest in the orange, and you can see that it's below both the 2021 peak pricing and the 2022 peak pricing. Santa Clara County is now below its 2022 peak pricing, but significantly above its 2021 peak pricing. Alameda County is below its 2022 peak pricing and exactly equal to its peak pricing in 2021. So it's important to understand those differences. Not all ships go up and down with the tide. Each one of them goes differently. So now you can see the same thing. The previous one was on log paper. This is on regular paper, so you can see the same concept. I prefer log paper because you can go back and see the rate of appreciation. Here's the monthly payment. So again, now I'm just going through the interest rate calculation. So this is going to be in the same order as the cost. So San Mateo County is the highest monthly payments at just about $15,250. And Santa Clara County, it's going to be about $14,500. And Alameda County, the most affordable, is going to be coming in right around $10,000 a month in payments if you did an 80% loan and didn't get a hold of a jumbo loan, and potentially relationship pricing, which is basically boils down to if you have money, whether it be in stock or retirement accounts, if the same institution you borrow from has control of those, they give you better pricing on your interest rate on your mortgage loan. Here's a summary of the micro markets we're going to go into. Here's the micro markets on the left-hand side. The conditions you're going to see. The first two columns are white because they're really not leading indicators by themselves. The yellow are what I call my leading indicators. They tell you what the market's doing right now. So those are the conditions in the marketplace. And then the orange highlight are lagging indicators. And then again, the white ones over here at the end aren't really indicators of what the market's doing. They're just informational based. So you can pick your micro market areas. You can come over here and pick your price. And the middle number is the median. The lower is the cheapest you'd reasonably expect to find in that area. The right number is the highest you'd expect to find in the areas. And then after that is the payments. So you can start either with your payments or your purchase price target or your geographical area on the left. And then you look in between the left and the right, and you find out what the market conditions are going to be for that particular micro market area that you're interested in. So here's the micro market areas. So this is active inventory. So a lot of it is slight pink in color, which indicates less inventory than you normally expect. And the actual percentages over here, basically from 87.5% to 112.5%, I consider to be normal. And that would be white in color. Below that is pink in color. Moving on to offers. Here you clearly see the blue color, and that means we're having a lack of offers for it. Again, you can see the individual numbers. And it's the same concept from 87.5 to 112.5% is white in color, as you can see in these areas. And then if you're below that, you're blue in color. So clearly a lack of offers. Here's your speed of the marketplace. You can clearly see the slow areas in San Mateo County. Most of the valley is white in color, which means it's reasonably balanced. So you're close to 100%. You're on each side of 100%. Here's the days of unsold inventory in raw count. So you can, not compare to normal, but just what's the speed of the marketplace. And I consider anything from basically under 6 weeks to be a hot seller's marketplace, anything from 6 to 11 weeks to be a balanced marketplace, and anything above 11 weeks to be a cold buyer's market. Here's your time on marketplace. Here, anything under 3 weeks is a shade of pink. Anything above 6 weeks is a shade of blue. So you can see the only area that's blue is the coast, where it's taking a long time to sell. A good part of the Silicon Valley is selling quickly, and the part that isn't selling quickly is selling at a normal pace. Here's ask price adjustments. So this is how much the sellers are doing price adjustments. Again, they're all downwards. The most significant downward one is San Mateo County Coast at 3.7% price reductions, which may not sound like a lot, but because a lot of the sellers don't do any price reductions, that is fairly significant. And in the coast, I believe roughly 50% of the sellers aren't doing a price reduction. So the 50% of the sellers that are doing price reductions have to be on average doubling this, which would be about 7.5% price adjustments in the downward direction. Yep, here's the 50% I was talking about. A lot of these areas are red in color, which means the market's moving fast enough that sellers aren't doing their price adjustments yet. You can see a lot of the areas in San Mateo County are less than 10%. Santa Clara County looks like it's closer to 15%. Here's the magnitude of overbidding. So this is how much the buyers are overbidding on average, which includes the ones that are going in less than ask price as well as the ask price. So this number is not the typical amount of overbidding, which would be a higher number, but it still gives you a relative number. You can see the only negative number is the San Mateo County coast. This is the frequency of overbidding. So you can see the frequency is only 16%. In the coast, it's only 35% in the expensive areas. Most of the areas are from 50 to 70, 50 to 80% overbidding. So it's still very common to overbid. Here's the long-term appreciation. You can see the San Mateo County coast, the peninsula, which used to be the desirable place to be because it was short commutes, has had the least amount of appreciation. The areas with the longer and more affordable pricing are the areas that have the most appreciation. Here's the sold prices. And again, you can see the more affordable areas are the areas in the previous slide that had the most appreciation. And again, instead of just following the median price, which is the middle, I sandwich it so you know the sort of the whole price range. So in Redwood City, you can go from about 1.5 million to 3.5 million is sort of the price range for Redwood City, with the typical price being right about $2 million. Again, here, the lack of offers is showing up. We're basically the 9th worst year. The only year that was worse was last year. You can see that most of my 8s are disappearing as we update the numbers. I believe, oh, this one actually got updated to 9. I didn't catch that. So this one now is the second. So the only one that's in 8th place is basically 4 weeks ago. We were 2173 versus 2097. I don't think that's in a reverse because enough of these have closed now that it's unlikely to drop very significant, and we now have to drop 100 to get below. Here's the actual numbers for either Santa Clara County, San Mateo County, or Alameda, or Silicon Valley as a whole. One of the things that I noticed was the drop in inventory. New inventory is down 5% in Santa Clara County, so that sort of stood out. It's also down 4% in Alameda County. So you've had a drop of new listings coming on the market, which is going to keep the supply limited. With that, we've been talking about Silicon Valley in the Greater Bay Area is up next. I want to do a little how to participate live thing. So how you participate live is you jump down here to what I call my green root URL. You add in 2024. You do that at 9 o'clock Saturday morning. I don't join on early, so you'll have a screen something like saying the host isn't here yet. If it asks for the passcode, here it is. You're welcome to join. If you want the handout, which I did get up about 10 minutes before the 9 o'clock hour, you add in the letter H, 2024-07-27 for today's year, month, date code. The H is for handout, and then you get a 66-page power split handout. You get all the significant handouts that we've done here. This is 132, I think it is. You don't get the ones that are essentially repeats to get the moving data. If you want any particular archive, you can go to the specific episode directly, or you can use the blue YouTube archive, or the root URL takes you to the archives. So with that, I'm going to pause, see if anyone's got any questions. Seeing no questions, I'll move on to the Greater Bay Area. Here are the 5 regions that we're covering. Silicon Valley, we've talked about extensively. The cities of San Francisco and Marin. North Bay is Sonoma, Napa, Solano, Contra Costa, San Joaquin, and Sacramento make up the Central Valley, and Santa Cruz and Monterey make up the Central Coast. Here are the 5 lines. Notice Santa Cruz, Monterey, down here, the Central Coast is really coming up on inventory. It's not quite back up to their normal levels, but it's getting pretty close. The San Francisco Marin is still short inventory. Silicon Valley, I'm short, but it's not that short. But the Central Valley and the North Bay are still quite a bit off of their marks. So they're off the most. The Central Valley would be off the most because you come back historically and look, North Bay and Central Valley are very similar through all the years. And now North Bay is on top of Central Valley. So it's got the least inventory. And likewise, Santa Clara, Silicon Valley is doing better than even the Central Valley because they're basically very similar together right now. And normally the Central Valley is quite a bit higher. So actually Central Valley is missing the most. North Bay is missing the second most, and probably Silicon Valley is the third most. Here is looking at the offers for the past little time. Notice the large increase in both the North Bay and Central Valley on the number of offers. This is a little surprising to see this increase in number of offers. In fact, if you look back historically over the time for Central Valley, I don't think I've seen these kinds of magnitude of increase. I did not check my data, but I'm not aware of any issues with it. But when you see 2 areas go up like that, it's a potential possibility, and we'll look into that. I'm not aware of it now, and I think the data is accurate. Here's now looking at your days of unsold inventory, and because of the increase in offers, your North Bay and your Central Valley DUI is speeding up, where your other areas are slowing down. The cities are slowing down the last couple of weeks. Silicon Valley has been slowing down longer, but bouncing a little bit. The 4th of July, we've talked about that. The impact was bigger this year. And even the Central Coast has been climbing fairly steadily the last several weeks, so almost the last quarter. Here's the marketing time for the different regions. Silicon Valley is by far the fastest marketing time. 75% of the homes are selling in 20 days, which is just under 3 weeks. Then you have the Central Valley at 32 days, cities at 38 days, and the Central Coast at 40. So all 5 regions are selling in less than 40 days. 4 of the regions are between 30 and 40 days, so fairly closely together. And the fastest is on the standout. And when you look back historically, it is usually the fastest. Silicon Valley is down at 20 days. Here's your average ask price reductions. Notice they're all decreasing, which is the way I've plotted this is an increasing amount of reductions. And it's been basically going on from shortly after the dividing line here between first and second quarter. Probably the last to break would be the North Bay, but it's come down, maybe even the Central Coast. Yeah, probably the Central Coast is a little bit later. The earliest to break looks like the cities. It broke right on the quarter. A week or 2 after that was Silicon Valley, and a week or 2 after that was the Central Valley. And then I will go with North Bay, and the last one to go down or increase in number of price reductions would be the Central Coast. Now we're looking at the magnitude of the frequency of those price reductions. Central Coast has done a reversal in this last week, so that's an encouraging sign. But look, all 5 regions in the long term have been going up, and no indication this is changing. The first one again to change was the cities, and in this measurement, the next one I think to change would have been the Central Coast, and then the Central Valley, and then the North Bay, and finally Silicon Valley. So Silicon Valley saw the increased number of sellers taking price reductions, was the last holdout. And, it's still not a huge number of sellers. The top cluster is up here approaching 30% of the sellers are doing a price reduction. The cities is at 22%, and Silicon Valley is at 16% of the sellers are doing a price reduction, which is only 1 out of 7 sellers are doing a price reduction. But if you're selling your property in less than 3 weeks, you almost don't have time to do a price reduction. So now we look at the magnitude of overbidding, and the one that's the highest is Silicon Valley at basically 6.25% overbids. The cities is very close at 6% overbidding. Then you jump down to the North Bay, which is just over 1% overbid, maybe about 1.1% overbidding. Then you come down to the Central Valley, which is basically at less than a quarter, so maybe 0.2% overbidding. And then you come down finally to the Central Coast, and it's somewhere around 0.75% price reduction. So there is no overbidding on the Central Coast. Well, there is going to be some overbidding, but on average, there's a small price reduction for the Central Coast. Here's the frequency of overbidding. Again, the rollover pattern is sort of interesting. If I was to guess, here, the Central Valley rolled over first, followed by the cities, followed by Silicon Valley, and followed by the Central Coast. So the Central Coast was the last to start having lower frequency of overbidding, but you still have significant overbidding, somewhere around 35%, maybe 36% for the Central Coast, somewhere around 44% for the Central Valley. The North Bay is about 49%. The cities is up here at 58%. And finally, Silicon Valley is about 68.5% of the sellers are getting more than their asking price. So for Silicon Valley, that's almost a little bit more than 2/3 of the sellers are getting more than they're currently asking when the offer comes in. Here's the long-term appreciation. Notice that Silicon Valley has really started to roll down. All of them, well, 3 of them are rolling down. Central Coast has rolled down, Silicon Valley and North Bay. The Central Valley did a little dip, but is going back up again, and long-term is still continuing. And last place with the least amount of appreciation at only 40% is the cities, which is San Francisco and Marin. And it's really remarkable seeing the difference when you come back here to the pandemic. They were all clustered very closely together. And once the pandemic hit, the cities really did not do well. Here's the sold price for the different areas, and this is all median sold price only. The most affordable area is, of course, the Central Valley, followed by the North Bay, Central Coast, and the cities in Marin are basically neck and neck, right tied for each other as far as pricing is concerned. Here's the monthly payments, and because it goes through the formula is the same, you're going to be neck and neck between the cities in Silicon Valley. Central Coast is the middle number. North Bay is second lowest payment, and Central Valley has the lowest payment. And keep in mind, this is assuming an 80% loan, and you can get a lower interest rate by doing jumbo money here in California. This is using the national average for conforming loans published by the Federal Reserve Bank. So it gives us some benchmark, but it's not really relevant for what's going on here. Here's the actual numbers for the different counties. I do have Silicon Valley, and I also have the 9 Bay Area. I don't believe it's very useful, but I put it in here because the media talks about the 9 county Bay Areas all the time. And by putting it in here, you can see how different it is compared to several of your cities. For example, 22 days here for Santa Clara County and 36 days for the Bay Area. So that's quite a bit of difference. Thanks. Let me see if you can learn how to pay attention to this earlier under how to participate live. We've been talking about the Silicon Valley real estate market analytics for July the 27th. And we just finished up with the Greater Bay Area. The handout is by typing in the green root URL and then H for handout and the year, month, and date. And I'm Richard Calhoun with Creekside Realty. My contact information is there. And let me see if anyone's got any questions. Not seeing any unmuted mics. Thanks for joining. Take care. Bye for now. See you next week.